what I think more successful franchisees need to do is start learning the investing game once they've mastered the entrepreneurial game or the franchising game.
Representing Franchise Secrets, Erik Van Horn.
Hey, Franchise Secrets. Got a solo episode with me today, and I've been thinking a lot about how people go from an operator, a franchisee, a small business owner to being an investor. And some of it has come from some conversations that I've had with some friends of mine who are in the process of buying out other franchises. And I'm having these conversations because I'm in the process of buying out other franchisees as a multi-unit franchisee. I'm an investor in this group. I'm not an operator, but I'm providing guidance to my operational partners on how we do it. So we're in the thick of it with LOIs, purchase and sale agreements, lease reviews, and all of that kind of stuff. Quick side note, I've created a lot of custom GPTs for this type of thing, whether it's monthly financial reviews, LOI, putting together these LOIs or reviewing leases. So if you're not taking advantage of AI and understanding how to let that help you and save you a bunch of time and money, you should probably look at that. I'll be giving away some of these GPTs inside the Facebook group Franchise Secrets. So we found that to be very helpful as we're in the middle of negotiations and just refining operations and then managing by the numbers as well. So just a little side note on that. But back to some of these conversations that I've been having with franchisee friends of mine, and they're talking about some other friends of mine and talking about large deals that they're doing and why they're doing it. And I thought it'd be relevant to talk about today. A lot of people that are initially in franchising, they're happy to come in, make $100,000, $200,000, $300,000, replace their corporate income. And they're really happy with that because they're working 40 hours a week and they don't answer to anybody. They're their own boss, and that's success to them. And that's success to a lot of people, but that is not success to some of the people that I'm going to be talking to you about today. That's not what I'm looking for. That's not the end game for me. So one of the strategies that my friends are using, and they've been in franchising for many years. So don't think like what I'm about to share is, oh, I can do this in 2 years or 3 years or 4 years just by myself and being new to business, new to franchising, and have the same success as somebody that's been doing it a long time. But one of my friends has exited for multi-millions of dollars, only for, I think, probably 3 locations, maybe 4, maybe 2, but multiple millions of dollars. Multiple meaning more than 3, and it's pretty much a cash deal. So they are cashing out, and their plan to cash out of that is to pay off all of their debt, which, they're going to have still probably 10 locations of a franchise. So they sell a few of them, make a few $1,000,000 and pay off the debt, and still have the vast majority of their locations printing money because they're doing very well. And I know that, and there's multiple people that I'm talking to that are doing a similar type thing right now. And they are able to sell it for a lot of money because, one, it makes a lot of money, but it makes a lot of money without them being involved in the business. So they've removed themselves from the business for a while. And that was strategic. And I think that's something that a lot of people getting into franchising, they need to think more strategically about how do they get themselves out of the business. Not out of the business just to go on vacation or sit at the beach or go boating or whatever it is, but to build a business that is worth a lot more money without them involved in it than it is having them involved and being that owner operator. Because sure, they probably paying somebody $300,000 is my guess to oversee the operations. And because they're doing that, they are able to completely step away from the business and manage that one person, that one high level person, and that person probably has some type of equity, I'm guessing, or some type of profit sharing if they don't have actual equity, which, by the way, not everybody should be having actual equity. Even if they want it, they may not really want what it comes with, which comes with risk, comes with, lack of guarantee of different things. So there's a lot of things that equity, there's negatives to somebody that wants equity. But on the flip side, the good thing about it is they can participate in a nice exit like that as well. But there's some ways to have a participation in an exit that does not mean giving real equity. So anyway, back to my friend selling his some of his locations, and so he sold them, and then he's paid off the debt, and life is really good. Life probably did not change for him though. Like, that's the interesting thing. Life probably did not change for him at all. The only thing that changed is, instead of using the cash flow from those locations to pay for the debt and having more cash flow, he got it all in a lump sum, paid off all the debt, and probably has a little bit less stress, and probably has really, really strong cash flow. So what he's probably doing right now, or if I was advising him, what he probably should be doing, is investing strategically that money. And I'm sure he is. He's a really smart guy, and I believe he's already been investing outside of franchising once he started a cash flow. So I think the takeaway there is, what I think more successful franchisees need to do is start learning the investing game once they've mastered the entrepreneurial game or the franchising game. So once you start making really good money, you've stepped away from that business. It doesn't revolve around you. You need to start thinking more about investing, and that goes way beyond the stock market. The stock market, I have money in the market. I don't have a lot of money in the market. I have a lot more money in private deals, debt deals, all kinds of different things outside of the market. And I'm very diversified. And so that's one of the things that I've been doing for a number of years now. And it's probably the best thing, one of the best decisions that I've ever made as a successful entrepreneur, starting to learn the investing game and starting to learn tax strategy, because a lot of people, they could have made way more money on their exit if they set it up the right way. Instead, they are paying astronomical amounts in taxes just because it wasn't set up the right way. Now, obviously, I'm not talking about cheating the government or even delaying tax payments or tax obligations. I'm talking about ways to structure things that are mitigating taxes so you can invest more into the business, buy another business, open another location, have more money to invest passively. So that's the stuff that I love to talk about that is outside of franchising. But here's the deal. So you've got different ways to grow and different ways to build a business that is sellable. And that's the kind of the main point of this podcast. I want you to build businesses that are sellable, that somebody wants to buy, versus just thinking, how can I make money? Look at your P&L. Is it above what you were making in wages before? If it was, you're really happy. Like, there's another game. Like, that's the beginning of this journey in franchising, both as a franchisee and a franchisor. All right. So here's a couple different ways that I've seen franchisees make a ton of money. They're buying out a tired owner. The owner is exhausted, just doesn't want to do it anymore. They probably are making a little bit of money or not making very much money. Or maybe they're making a lot of money, but they're just exhausted, or life changes. They're tired. Their locations probably has not been updated. Their employees are probably, just as tired as they are because there's no real culture in the business. Those are really good ones to take over. I love to take those over because you can get them at a pretty good price. There's lots of levers to pull to improve, whether it's marketing, there's culture, there's the new hires, there's all kinds of things that you can do to quickly, go through the operations and clean it up and make the business more valuable in apartment or multifamily investing. That's like a value add. There's levers to pull when you are when you take over an apartment complex that has not been updated in a while. The owner let it slip, and so you have levers that you pull there, clean it up, mow the lawns, put in a play area for the kids, put in some pickleball courts so people like me could play there, and all of a sudden you have an apartment complex that is more valuable. And if it's more valuable, you charge more rent, and if you charge more rent, it's worth more money. Same kind of thing if you buy a tired franchisee out. And then you've got just underperformers. And I've done that. I bought out tired franchisees before, and I've been that tired franchisee before. So I've been on both sides of that. Underperformers, that's real value add, but you have to be really careful to understand why they're underperforming. I was talking to a friend of mine. It's always a friend of mine. I've got so many different friends in all kinds of areas in franchise, and this one just popped into my mind. They said, boy, we would be much more successful if we had bought out one underperforming locations versus two underperforming locations. So, well, tell me more. What happened? And I'm like, well, there's these two. We got them at an amazing deal, much lower than it would cost to build these things out on our own. And they said, the franchisor was like, yeah, these are just, poorly run locations. Well, come to find out, real estate was in a very bad location for one of them. And they just didn't really understand it until they found out themselves that the real estate was a main reason that thing was underperforming. And we all know location. Location's so critical. So if you are buying an underperforming location, my biggest fear for you would be the location itself. You need to understand it all. As a matter of fact, when we were getting ready to purchase some locations from a franchisee, I had one of my business partners. I'm like, guys, go search, call the city, search, and see what projects are in the future for the main streets that they are on, or anything near it. Because if they're replacing the water line underneath the street, that thing is going to be closed for a period of time, and that will hurt. Or, if the owner of that retail location is going to go through a major remodel, you want to know that, because you're going to be hurt in the meantime. So, it's things like that you need to understand from a location standpoint. It's not just what has happened historically, but what is happening in the future. So location is so critically important when you are looking at buying out an underperformer, especially. It's easy to think like, oh, the team's bad, I'll just upgrade the team and then I'll start creating more value, or I'll optimize the cost, or I will tweak this in marketing and whatnot. But the management is not an easy fix. Upgrading the team is not easy. All that takes time. It takes more time than you think, but you can really buy some franchises out and get really good deals on them. But it's only a good deal if you can turn it around and have some strong units. And I would say if you do 10 of those, you're probably going to have 1, 2, or 3 of them that will not be able to be turned around. You just don't want to get that on your first one, because then it's really hard to grow after that.
Attention, franchisors and franchisees. There are 2 really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisor and you're frustrated that you're not awarding as many franchises as you thought you would, this is the reason I created the Franchisor Mastermind. If you want access to the information, the techniques that the best franchise sales organizations are using to award franchises, and you want what mature brands have with their playbook of having happy, successful franchisees that grow the right way, then you might want to check out the Franchisor Mastermind. The reason why people join is they want access to my Rolodex, my connections. They want the playbook to achieve both short-term and long-term success. They want to increase enterprise value in their brand. Links will be in the show notes or at scalablefranchise.com.
Here's another one. And this is what my friend did. My friend that just sold 3 great locations, he bought strong assets. He bought strong cash flowing businesses, paid a lot of money for them, but eventually pretty much doubled his money in about a 1.5 to 2 year period. So he bought out performing assets, strong locations, made them even better, and then sold them as very good, high performing assets. So think about it. They're good. You make them better. And now somebody's paying a multiple of cash flow because their play is probably different than your play. They are probably doing a roll up play. You may not be doing a roll up. They probably have different levels of buyers. So they're buying them out, and they have probably a more of a strategic buyer that will buy out their locations at the end of the day. So you need to understand where you are in this chain of a seller and a buyer, and why somebody else would come in and pay the highest multiples on a highly profitable business, because they're out there, but you just need to understand who your buyer is. So that was his strategy when he bought out these strong locations and then added some value, because he was able to put those 3 locations into his own ecosystem, where he had systems in place because he already owned multiple locations in of this particular brand. So he plugged them in, probably had some cost efficiencies, and then sold them, made a ton of money. All right. So as you are growing your businesses, as you get more focused on just looking at a basic growth strategy, you need to really review the financials, like on a monthly basis. You need to look at EBITDA. You really need to look at cash flow. Like EBITDA is one thing, earnings before interest, taxes, and depreciation and amortization. That's one way to look at it as you're looking at, profitability, but cash is king. You've got to look at cash flow. So as you're looking at your financials on a monthly basis, you need to look at it and see what you can improve. And then you need to hold your leadership accountable to the numbers that you see. And are your costs coming in where they're supposed to? Is your marketing coming in where it's supposed to? Is your sales team closing what they should be? And a lot of stuff is in your numbers, in your financials, and then just in your KPI. So you really need to be, this is where you are getting out of working in the business to working on the business. You are looking at those types of things, and then you're holding your leadership accountable, and you're making decisions based off of the numbers, just not based off of your gut or what you think or the newest or latest idea that you have. All right, let's talk about exit. So you're building a sellable business. Going back to my friend, he built a sellable business. I don't know, at least 10 locations. He sold off a few of them and kept the rest of them. So he didn't fully exit. He exited and made a lot of money, but he still has a lot of cash flow. A lot of people think it's all or nothing. You're exiting and it's either I'm in or I'm out. And the reality is you don't really know what you're going to do. That's why I love to build sellable businesses. So then you can choose whether you want to sell everything, sell part of it, or just use that as your cash cow to be able to go do other things. And I think one of those other things should be learning how to invest your money. And I don't think a lot of entrepreneurs are necessarily great at investing money and tax strategy. I mean, a lot of CPAs aren't good with tax strategies. They're CPAs. They're the not so great ones are more focused on keeping you out of an audit versus thinking, how can we help you save money on taxes and defend an audit? So if they're afraid of audits, I would say you have the wrong CPA. If they are bullish on defending audits, I would say you have a CPA that's a tax strategist, because they will go fight for the strategies that they've given you. And then they will give you the different strategies and the risk level of audits and whatnot. Maybe you're afraid of an audit, and that's okay. I'm not afraid of audits. I've been audited. I've defended an audit, and I really didn't have to get that involved. I think a great CPA will go defend the strategies and what you actually implemented to an auditor, and they should win most of them. And I know some of my best people that are really good at this kind of stuff. They usually come out with making a little bit more money, and the auditors like give in on the things that they were trying to look into. So, but I love CPAs that can, or strategists that can say, yep, we've defended this in an audit, and then they can tell you why. So those are the kinds of CPAs, tax strategists that you really want. So the main point is make sure you have the right CPA. It's really hard to find the right CPA, but you need to probably every few years give your tax return to a different CPA, see what they would do differently, why they would do it, and then you're always making sure that you have the right CPA for you. And then as you want to learn how to be an investor, because this is a skill set that most franchisees, most entrepreneurs don't have, and they learn it. I've talked to inside the mastermind that we have, the Tribe of Investor Mastermind. We have a lot of people that have exited their business, and they are now, for multiple millions or tens of millions of dollars, like high net worth people, and some, for $1 million or $500,000, whatever it is. A common theme that I see is they've sold, they've exited, they've got more cash sitting in their bank account than they've had for a while, or maybe ever, but they take the time to start as a student to learn the game of investing and tax strategy. They don't deploy capital out of emotion or out of fear of missing out, or just like, I've got to get this money to work for me. They don't make these reactive investments. They are thinking, I want to protect this liquidity. So I think that's one of the bigger mistakes that new investors make, is they just start deploying cash right away. And I tell you what, I've done that. I've been there, I'll throw $100,000 at this angel investment. What could go wrong? And then nothing has gone wrong in a year. So I'm like, well, do another angel investment. Let's put there's two friends that have, a minimum of $50,000 each to put in their different angel deals. So I'm putting in another $200,000. And all of a sudden, you do that a couple times a year. And then 3 years later, you realize that all of these deals have gone belly up, because angel investing is really hard. The people that do that, they have a specific plan, and that's what they do. And so I've lost a lot of money making the wrong choices early on with more angel deals. And you can, angel deals are just common because most of them don't work out, and most people know that. But the same could be said of apartment rehabs and flips, or whatever it is. People get into the wrong deals because they have a friend, and the friend tells them what the return's going to be, or what they think the return's going to be. And investors start chasing returns versus risk mitigation. And that's a big thing that it's easy to miss. It's so easy to be like, I'm chasing a return. This is the return I want. I want a 30% return versus a 20% return, or versus a 18% return, because returns are better. But they're not thinking about protecting the downside. And that's probably the biggest mistake that new investors make. And so you always want to think about the downside. And I think you want to learn how to look at investments before you actually invest. So look at some deals, look at some decks, and start to understand waterfalls, start to understand, capital calls, start to understand like what their investment strategy is to get a return on your money. And then start to look at their history. Here's a deal that I did. So this was, I think COVID was happening, or just before COVID happened. There was a large investor that had a very good track record of success. And they were doing office. I'm like, well, what could go wrong with office space? Office is great. Everybody needs an office. And we did not know how bad office was going to be during COVID and post-COVID. We just didn't know that. But I thought, boy, office, this is great. I think it's great. And it looks like they have some big office clients like Amazon and big names like that were sniffing around, ready to buy. And they were getting it at a steal. So what could go wrong? Well, the only reason that I invested into this is because there was a clause that said, hey, if you want out of this investment for any reason, and all you have to do is just say, hey, I want out of this investment, and within a handful of months, we'll give you your investment back. So that's the one reason I invested into this. And the reason that they did that is because it's a risk mitigation strategy for investors coming in like me. They don't never would have gotten my money if they hadn't had that clause in there. So I invest in the deal. I'm getting paid. Like they said, I was going to get paid for the first couple years. And then all of a sudden, payment got missed. They communicated, hey, things are tough. Payment got missed. And they were really good communicating all of this stuff to me. And I thought, I remember that they said, if you ever want out of this investment, all you have to do is just let us know. And they said that's happened to them before in a project, and they paid everybody back. So here I go. I send the email, hey, I want my money back because, this isn't paying off like everybody thought it would. So they said, okay, here are the things that you need to do to be able to get your money back. And it was like, send an email here, wait this long, post here, do this, do that, and then you'll get your money back. Well, handful of months later, I think it was about $100,000 came back into my account. And that is what I talk about with downside protection. Now, do most investments do that? I would say no. I have not seen many investors protect you on the downside like that. Now and you can't do that every time. Like that's a one-time thing with this group. If you want to invest with them and you just want that level of protection and be able to use it whenever, you can't. It's like a one-time thing. But I tell you what, I have a lot of respect for that group, and I would invest with them again in a different asset class. And they have multiple different asset classes. They're diversified. They're going to be fine. Even if that thing goes belly up, they're going to be great. But I wanted to give you guys an idea of what downside protection really looks like in the real world from an example of me taking advantage of a clause that was in one of the agreements that I had with an investment that I was in. So I think you need to understand, like, what is your investor identity? Who are you as an investor? In other words, before you write checks, define your new filter. I don't invest in X. I look for this. Maybe it's I don't invest for just, angel deals. I look for doubles and singles versus home runs. Maybe you want the most downside protection that you can have. Or you invest in sponsors or the person originating the deal that have been through multiple different cycles of the market, the ups and the downs. So whatever it is, you should be able to have your own investor identity, the criteria that you use to invest. You should be looking at your risk tolerance. So part of those things in that investor identity is your risk tolerance. Like, what is that risk tolerance? And then, like I was saying earlier, do you want cash flow or do you want appreciation? Or do you want some type of mixture of both? And maybe you want 50-50. Maybe you want 50% cash flow, 50% appreciation. Well, what you should probably do is watch what your actual investments are like. So then you can be like, okay, the deal is 50-50. Or maybe you've done 2 cash flow deals and now you need some appreciation deals. And that's how you go about it. Like, I just invested in some appreciation deals in some professional sports, and I did it through a group. But I know that we just bought into one of the NBA teams. And then it's really NFL and NBA. Those are the main deals. But I put a significant amount of money in there, and it's longer term. The capital is called as they start buying into some of these teams. So it doesn't come up right away. It's probably going to be over a 3-year period. But that fits into the bucket of appreciation that I want. It's not cash flow, and that's okay because this goes into a long-term bucket for me. Also, you need to be thinking about your tax priority. Like, what do you want? Do you want tax mitigation, tax deferral, or any type of tax treatment? And does that deal give you the type of tax treatment that you want? Or even the vehicle that you invest through. Maybe it's through a whole life policy. Maybe it's through, like I do a lot through my pension plan. That's just for my particular LLC that I own with my wife. We invest through a pension plan with that. So we can put we can fund that. And then there's some tax advantages that we have with that. So that will fit a certain bucket as well. And then you just want capital preservation, or do you want growth? Sometimes you need something that's going to preserve that capital, that's really stable, and others you just really want growth. And again, all of this is a mixture, and all of this is something that it's really personal to you. Where I would start is I would look at what the family offices do, or what the billionaires do with their capital allocation. And you'll start and use that as a guide. And then actually what I'm going to do too is I will, in the Facebook group, I will post a GPT that I've created that is, it's just called my family office GPT, but it talks about it has my framework of everything in here, along with others like Ray Dalio, Warren Buffett, Justin Donald, and different folks. So, but that's a good place to start. And you just need to start to understand your own investor identity, build your own capital allocation plan. Like, where are you putting your dollars? Like, how much is it in stable, long-term, boring businesses, boring investments? Think real estate with somebody that's been doing it, for 30, 40, 50 years, and they've seen the different cycles, and they've seen the interest rates go up and down, and they study different markets. Now, not every market's similar. If you think about diversification in general, you might be in real estate, but you might be in like a single family home, or like a multifamily syndicate, and you're in Austin, Texas. And that's different than being in Columbus, Ohio versus someplace in North Carolina or Nashville, Tennessee, or California. So as you start to build out your plan on where you want to diversify, even within an asset class like real estate, you need to be thinking geographically as well. In addition to real estate so broad, you've got single family, multifamily, commercial, industrial, land, all kinds of different things. You just need to start to think about all of that and start to understand where you want to put your money to work. Here's another little tip. If you're new to this, I've seen first time investors, sell a business, and they put way too much into one or two sponsors, the people putting the deal together. Maybe they've made $1 million in their business, and they put $1 million across 3 different deals with the same sponsor and the same asset class in 2 different markets. I think that's risky. Like, that's a high level of risk. One asset class, one geographical area, maybe different markets, but same geographical area, and one sponsor. That's high risk. So if you had $1 million, what would you do? Where would you put it? And I would not be doing the same sponsor, three different deals. And it might be a huge winner. And if it is, the mistake that they might make is thinking, oh, I'm really good, I'm just going to continue to double down. And that might work for a while, or they might, completely bomb the next one. I think just diversification across asset classes, across sponsors. I think a lot of people kind of FOMO into a deal, fear of missing out, or they think this deal is the greatest deal. So instead of putting $50,000 in as a minimum investment, they put $200,000 in or $300,000 in. Like, there's always more deals that come up. And if you just start to learn and start to put money in, like, I'd be a fan of putting $50,000 into multiple different deals versus putting $1 million into 2 or 3 different deals. So that is like a very, very broad overview of what it's like to go from that successful entrepreneur, successful franchisee to an investor. And I'm going to drop that custom GPT into the Franchise Secrets Facebook group. So if you're in there, just ask me for it. I'll give it to you, but you can just start to ask it questions and say, hey, this is where I am. I'm making $300,000 a year. My living expenses are $100,000. What should I do? And at that point, like, you still need to build up more cash flow. But if you're like, hey, I have $1 million of free cash flow, I'm keeping my lifestyle expenses the same, what should I do? And I'm preparing for an exit in the next 3 years. How should I look at that? Those are different types of questions. And those, people like that are the ones that are joining our mastermind. And one of the best things that we do initially in the mastermind is go through some tax saving, tax strategy type courses, type conversations to really make sure that when you do sell, you are not just tipping the government, because some people like to tip the government. I'm not one of those. I like to pay what I need to pay, but I don't want to pay more. I'd rather give it away or do something with it, because I'm much more about building generational wealth than I am about tipping the government. So anyway, there's a little crash course, a little taste of what it's like to go from a business owner to investor, and some things to keep in mind.
Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.